I mean, obviously, we love the Class C area. That's the area that we're in. I've heard this so many times over the last couple of years that this Class C space is this forgotten market. It's so weird. It's cyclical for sure. You have right now, I mean, it's one of the hottest areas in real estate is this Class C Midwest market space, and I think that has to do with the numbers overall. It also has to do with how Class C is defined, technically speaking, and the years that they kind of draw this arbitrary line and say, hey, that's Class C unless you can show these improvements or whatever. And so, when you look at Class C, especially in the Midwest, you're typically looking about 38 to 40% of the market. And so it's a huge portion of the market segment, first off. And then second, I mean, uh, some of these stats are are up to date as of this morning, so hopefully they're still up to date as I say this. But they are 95% occupied typically. You have a 97% on-time payment. You can just kind of go down the metrics, and it's a really strong class. And what a lot of people, initially don't like about it is when you think Class C, you think rundown buildings, maybe the tenants aren't great, or they just kind of pile on these assumptions that isn't true. I mean, we have Class C apartments in some of the best neighborhoods that you could find. I mean, just Midwest or South or wherever you want to go, because a lot of it's based on that year it was built. And so, it has nothing to do with location. It has nothing to do with the tenant. It really has to do with, when was it built? What renovations have been done? Where have you gotten it to this point? And because of it, you get this, for lack of better words, kind of stigma on, hey, Class C is really, a rough property to get into. But we're also, that's great. The numbers are great. The statistics are strong. You still have the other industries that play a role in that. And that's another reason why you talk about it being kind of forgotten or kind of neglected, really. The insurance is really tough to get on these as time goes on. And obviously that's its own industry with its own hurdles. And so you have that, you have the banks that also, if you're going to leverage it, you have to hit those metrics. And a lot of what we look at are these value add Class C multifamily apartments. And because of it, there has to be a value add. That's literally why we're getting involved in it. So you're not, we don't look for, hey, this is cash flowing hundreds of thousands of dollars and it's already operating really smoothly. And it's, that's a little bit ahead of where we want to get in at. And so because of it, you do have those hurdles, and that leads to that comment of it being forgotten, which is, insurance doesn't really like it, the banks aren't in love with it. You can give all the statistics you want on occupancy and on-time payments and go down the list. But at the end of the day, you're still, we still have to get covered on insurance and there's
Yep.
still things that we have to operate under. And so because of it, I think those other industries also kind of give it its own stigma, if you will.
So what are the ideal scenarios for a Class C for you to jump in and go, okay, we could really make a difference here? Because you just mentioned like it doesn't have to be, it can't be like a really well run Class C already. It needs to be something that you could do add some value to. So typically, what does that look like?
Yeah, so we look typically between probably about 150 and 200 properties a week, and we evaluate them primarily on expenses. And so we have our own segments and our own process where we will look at the value per door and the typical stuff that you've heard of. But where we focus on initially is the expense side. I mean, a lot of these Class C space apartments are run by families who might have collected this or inherited this over the years, and so they're not aware of what property management expenses really are. And I think the property management companies do a great job of explaining, a flat fee of 6%. And so everyone's just, they grab that tagline and just hold on to it. And the reality is when you actually dig into the books, you're finding that, there's a tenant retention, and then there's all these fees that get added to it. And really what we're finding is that those property managers are really more like 12 to 15%. So when we're looking at the expenses, we try to find what can be done more efficiently on the expense side. This isn't about getting in and, hey, we just raised rents $1,000,
Right.
because at the end of the day, that's not solving any efficiencies. You're just making it pay more money and then cycling tenants. If you want tenant retention to stay high, you got to focus on the expenses first. And so we'll look at, what is water and power. And, if they hit certain metrics, we can tell with the systems and software that we've developed, whether that's actually running efficiently or if maybe there are leaks and they don't know about it. And we're able to kind of tackle that on the front end before we even move into a deal. But then also, property management expenses. We'll look at any kind of CapEx that they might have done, and a lot of them, there has been some improvements, but they may be missing the mark on, right? So a great example is a property that we're looking at where, they have new windows and new doors, but they still have the same old locks. There's no way to get into the main door. The fobs are going out. They don't have a good network. And then, we start to key in on these inefficiencies that really lead more towards tenant retention. And so, once we get through the expenses, then we really start to focus on, okay, if we can manage the expenses and improve on that, what's the top three things that we need to tackle immediately to drive retention higher? Because again, it's not about, raising rents 200%. It's about how do you manage the expenses, put in the technology to solve the inefficiencies or improve them significantly, and then from there being able to adjust. And with that you drop expenses. A lot of these apartments are under market rent, and so you're able to look at what actually makes sense without driving tenants away just because you want to drive NOI, and you just, instead of messing with expenses, you just want to raise rents.
Right.